Lines of cars curled around American gas stations in the autumn of 1973, engines off, windows down. People waiting hours for a rationed few gallons while paper signs shouted, "No gas today," 2 years earlier. The United States had closed the gold window. The dollar was no longer convertible into metal. The old anchor was gone. The world needed a new one. In 1974, Washington and Riyadh quietly supplied it. Oil would wear the dollar like a uniform, and the dollar would wear oil like a crown. That arrangement did not just steady prices. It turned energy into the backing for the world's money and made the greenback king without gold. Here is how a fuel shortage became a monetary regime. After the Yom Kippur War, Arab producers cut supply and embargoed shipments to the United States and others. The price of crude roughly quadrupled in a year. Think $3 a barrel to 12 ripping through every budget from households to airlines. Inflation was already hot. This shock poured gasoline on it. Leaders feared two crises at once, an energy shortage today and a currency crisis tomorrow. If the dollar, newly unpegged from gold, also lost its role in trade, the global system could fracture into zones and barters. Washington's answer was not a speech, it was a deal. The term Petrodollars is simple and loaded. It means dollars earned by selling oil. Producers receive dollars for barrels. Those dollars do not sit idle. They flow back through banks and bond markets into loans and treasuries. That recycling keeps the dollar strong, keeps global credit liquid, and gives the United States a deep, steady bid for its debt. Oil had long been quoted in dollars, but in 1970, for the understanding hardened into policy. American officials courted Saudi Arabia, the swing producer and the custodian of OPEC's center of gravity, with 3 offers woven together: security, guarantees, and arms sales technical help to invest the country's windfall, and a deep, discreet market for placing those dollars into U.S. government bonds. In return, Saudi oil would be priced in dollars, and the kingdom's surpluses would be recycled through dollar markets instead of fragmenting into a dozen currencies. It worked because it aligned interests. The Saudis needed defense, modern infrastructure, and a way to park a tidal wave of revenue without destroying their own currency. The United States needed a new anchor for its money and a buyer that could absorb gigantic treasury issuance without drama. American and European banks, sitting in the offshore eurodollar markets, handled the plumbing. They took deposits from oil exporters and lent those dollars to energy importing countries and corporations that suddenly faced much bigger fuel bills. Dollars left Houston at the pump, landed in Riyadh as export revenue, reappeared in London as bank deposits, and then returned to New York as bids for treasuries or as loans to Brazil and Korea. One barrel, many balance sheets. Behind the scenes, the mechanics were surprisingly tangible. Central banks and sovereign funds placed orders with the U.S. Treasury. Some purchases were arranged quietly to avoid rattling markets. American engineers and contractors arrived in the Gulf to build roads, power grids, and new cities. Defense agreements thickened into routine joint planning. The feedback loop strengthened monthly. Bigger oil receipts meant more dollar deposits. More dollar deposits meant deeper bond markets. Deeper bond markets meant the dollar felt safer to hold. The safer it felt, the more contracts were written in it. Gold was no longer the story that protected the dollar. Network effect was. Of course, every fix writes new problems. Petrodollar, recycling, flooded developing countries with cheap dollar loans in the late 1970s. When Paul Volcker's Federal Reserve crushed inflation with double-digit interest rates, servicing those loans became impossible. The Latin American debt crisis of the early 80s was the hangover from the energy party. Dollars that had left OPEC, vaults returned as past due notices in Mexico City, São Paulo, and Buenos Aires at the same time. A dollar stronger on the back of oil flows made some American exports less competitive, even as it kept U.S. borrowing costs lower than they would otherwise have been. The crown came with thorns. Still, the architecture persisted because it solved more problems than it created. Oil producers preferred a single, liquid currency with predictable settlement. Traders preferred benchmarks Brent and West Texas Intermediate quoted and hedged in one unit. Banks preferred to intermediate a single river rather than a delta of small streams. And the United States gained a privilege almost no nation in history has enjoyed. It could run large persistent deficits in its own currency, satisfied that the world would absorb the paper because that paper was also the invoice for energy. In a system without gold, oil became the closest thing to backing the dollar had. Fast forward to the present, and the headlines cycle every year: de-dollarization. New oil pricing in other currencies, the end of the petrodollar. The truth is more boring and more durable. A currency used to price energy must offer deep, rule-bound markets for hedging and saving. A legal system that credibly protects investors. And plumbing that clears payments at scale without panic. The dollar's advantage is not that other currencies cannot buy oil. They can. It is that oil producers can convert those dollars instantly into almost anything, anywhere, with minimal friction and maximum discretion. And that the dollar assets they park in are deep, tradable, and most days boring. Replacing that mix requires more than an announcement. It requires decades of building pipes. That does not mean the story cannot change. U.S. shale production altered the energy map. America imports less crude than it once did, but still imports specific grades and exports refined products. OPEC Plus, with Russia included, calibrates supply to price more tightly. Gulf sovereign funds diversify into global equities, private assets, and ventures far from treasuries. Some producers experiment with non-dollar contracts when politics permit. Sanctions, seized reserves, and weaponized banking rails remind everyone that money is not neutral. It carries the flag of its issuer. Each of these threads pulls at the crown's fit. But watch what refiners, traders, and central banks actually do, not what press releases promise. Flow follows convenience and safety. If you want to read the petrodollar's pulse like a professional, track 3 dials. First, real interest rates in the United States yields after inflation. Higher, real yields attract savings from everywhere. Lower, real yields push money into risk. Second, the spread between Brent crude and the dollar index. When the dollar surges, commodity prices often soften in dollar terms and importers breathe. When the dollar weakens, oil's dollar price tends to climb and the energy bill rises. Third, the fiscal needs of major producers their budget break even oil price. When they run, surpluses, recycling flows are generous. When they run, deficits, they draw down assets, and the bid for safe paper thins. What does this oil money marriage mean for your wallet? In a strong dollar, subdued oil world, imported goods get cheaper and international travel stretches farther. Your U.S. stock portfolio tilts toward domestically focused companies. Exporters feel a headwind. In a weak dollar, high oil world, grocery and gas bills rise, exporters gain a tailwind. And energy stocks and pipelines often outperform. For savers, periods of sticky energy inflation are when Treasury, inflation-protected securities earn their keep. For small businesses that consume lots of fuel, it is when locking in supply or hedging a portion of usage can be the difference between a bad quarter and bankruptcy. Most of all, the petrodollar story is a reminder that money is a coalition, not a law. In the gold era, trust lived in a vault. In the oil era, trust lives in contracts, tankers, and a crowded dealing room that can turn crude into coupons and coupons into salaries within hours. That is why the dollar still wears the crown, not because of a single treaty signed in a single year, but because the system built around that understanding in 1970 kept paying everyone along the chain. Producers got stability and a safe place for their savings. Consumers got a common language for the world's main input. Banks got a river to cross-finance. The United States got the deepest credit market in history and a currency others willingly hold. Crowns can slip. They always do, eventually. They slip when the coalition that holds them together decides the bargain no longer pays. If the dollar ever loses its throne, it will not be because one cargo settled in another currency. It will be because someone else offered a better total deal, safe assets, predictable courts, thick markets, and a story the world believes. Until then, the most important price in the world, the price of energy, will keep writing demand for the same old script. And the same old script will keep paying for the world's safest stage. If this changed how you see a tank of gas, a treasury yield, or a headline about the end of the dollar, stay. Next, we trace the other half of the story. The offshore dollar markets the eurodollars that made recycling possible, and how a market without a country still moves every mortgage rate you will ever pay.